I'm Rowan Smith. I'm a fund manager with Setanta Asset Management. I've been with Setanta since the firm was founded in 1998, and since then we have been successfully managing funds across a range of different strategies. And we attribute our success to our effective investment approach, specifically the consistent application of that approach. We in Setanta are value investors, and at the core, value investing is really all about recognising that when you purchase a share in a company, you're purchasing part ownership of a business. That business is worth something. And some businesses are worth more than others. So the price you should pay for that share should be determined by the value of the business as opposed to the prevailing share price, because those two things can be very different. Simply because, in our view, investors can at times act in a very irrational manner. They can become overly excited about the prospects for some companies and in the process overvalue their stocks. And they can become overly pessimistic about the prospects for others and undervalue their stocks. And we believe that markets pull prices towards fair value over time. And so to benefit from that pull, we advocate buying undervalued stocks and selling overvalued stocks. And that's precisely what we're trying to do in Setanta. There can be a number of reasons why investors seem to act in this apparently irrational manner. Maybe the most important one is that it seems to us many investors don't seem willing or able to think or act in a long-term manner. And they might not realise that they're doing this, but implicitly sometimes they project recent trends and recent experiences far into the future, even though sometimes those trends turn out to be quite transient in nature. And so in doing this, they overvalue some stocks and undervalue others. And that's actually very fortunate for us really, because those valuation anomalies are the very opportunities that we are trying to exploit for the benefit of our investors over the long term. And we feel actually we've been quite good at exploiting those opportunities over time. In contrast to many other investors, our approach is very long-term in nature. And we don't really see that any other approach really makes sense, because if you think about it, the value of a business, broadly speaking, is equivalent to the sum of the profits that it makes over its entire lifetime. So think of a time span of perhaps 30 years or more. So in that context, what happens in a given quarter or in a given year is relatively inconsequential. So our orientation is always very long-term in nature. And specifically, when we're evaluating a business, we're always preoccupied with the very long-term prognosis for that business. With respect to existing holdings that might potentially be sold from the portfolio, or indeed potential holdings that may be added to the portfolio, the valuation case for each stock is critical to the decision-making process. And our approach to valuation is very flexible. It really has to be, because every business is different, and therefore, in our view, to get the most accurate output, you have to tailor the valuation techniques to each situation. So the metrics that we use will vary from stock to stock, but the overarching objective is always the same every time. We want to establish what price we can own this investment at to allow us to earn an attractive long-term return in the context of the risk profile inherent in the business. So our valuation approach always incorporates a risk-reward framework.